Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to discuss why even minor economic reports can move thin markets dramatically. Certainly, Steve, we see this in August trade. We see it again with the holidays and the beginning of the new year's, and certainly thin markets, even like when we talk about low volatility levels, those spikes can happen more fierce than other times of the year.
Absolutely, Jill. Great to see you as always. This week, we were sort of looking ahead to the bigger economic reports. We have GDP. Tomorrow, we have the Fed's preferred inflation measure, the core PCE deflator on Thursday, and of course, payrolls numbers on Friday. I think people were looking a little bit past, what seemed to be lesser numbers, consumer confidence and jolts today. But to excuse the pun, but we were certainly jolted out of our stupor a little bit when those numbers came in, because the jolts number came in way below expectations, and there was a revision to last month's number, and so it's definitely showing, I'm going to say, a bit more equilibrium in the balance between the supply of labor and the demand. The consumer confidence number probably might not have been a surprise, considering some of the what the retailers have said about spending. But in general, these were enough to really move markets. And the bond market, by the way, is just as thin as the stock market. And so we saw two-year yields, move from 3 basis points higher to about 10 basis points lower in a matter of minutes. And now we're still seeing markets equity markets continuing to rally. Arguably because of the bond market. You could also argue that we're, more concerned about liquidity than anything else. And so, off to the races we see this market.
Steve, you make a great point in the note that was published today that the VIX is not necessarily a directional measure. Explain to us why that's important to be aware of.
Yeah, volatility as an economic construct, or as a fundamental construct, moves both ways. Up moves count just as much as down moves. I actually have, sort of a pinned tweet about, what my friend Steve Sears and I call socially acceptable volatility. And a day like today is just as volatile as a down day, where we're looking at, NDX up about 1.75% or something like that. That's volatility too, but we like it. It's, it's socially acceptable. Markets are supposed to go up. Equity investors are by definition optimists, but volatility counts it's percentages. It doesn't really care whether those percentages have a positive or a negative number in front of us. So what happens is, but yet the volatility that underlies the measures such as VIX or Vol-Q is unaffected by whether the moves are up or down, but the level at which they trade, sort of the premium or discount to historical volatility, or anticipated volatility, really has a lot to do with sentiment as much as it does the numbers. And that's something to be careful about in a week like this, where we've seen that we can move dramatically on good news. Well, what happens if that good news is priced into the numbers going forward? Or what happens if these other numbers are not as positive as the one positive for bonds and the markets, not necessarily the economy, but positive for markets as these numbers today?
Yeah, and Steve, that's a great point that you make when it comes to sentiment, right? Because it feels as if the bond market and the equity market is processing clues from economic data and from the Fed in very different ways. They may have aligned a little bit better as of late, but it feels as if equity investors or the equity market, they're trying to dig anything out of economic data that suggests, to your point, a more optimistic look going forward.
Here's the thing. You could tell we still have good sentiment because good news is good news and bad news is good news for the most part. I mean, this month maybe has been a bit of an exception, but for this year so far, we've taken the good news as good news when I say good news economically as good news and bad news economically, both as good news. When you have a day where numbers that are not positive from an economic point of view have a drastically positive effect on markets, that's your tell that equity traders are more concerned about liquidity than the economy. And at some level, we are liquidity addicted. We really prefer to see, markets respond to stimulus. That's why you see the long and variable lag when the Fed is taking money out of the markets, and a pretty much immediate lag when stimulative monetary policies hit. Those take a matter of days or weeks. And so, equity investors particularly are super attuned to anything that hints at monetary accommodation. One of the things we're seeing today is rate hike probabilities for November fall from about 70% yesterday to about 45% when I just last looked before we started talking. So that's what the market's responding to. And in a thin market, those responses become even more pronounced than normal.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.